So welcome back to another Hacking Finance chat between me, David Galbraith, and Sean Park, founder of Anthos. This time, we are going to talk about retail and supply chains. And by that, I'll set it in context because it's not a traditional topic, but one which we're lumping together as we're deploying capital across sectors in this space. Is by supply chains, we mean everything from supply chain financing to modern types of ERP systems to what we've seen with companies in looking at shipping in terms of Flexport, etc. And then in the middle bit, there is the transacting and the financing component, where obviously we've seen buy now, pay later firms emerge, and we've seen new types of payments rails emerge for different payments rails fundamentally emerge in different geographies around the world, and lots of sort of change there in terms of what kind of metadata is flowing around payments. And then at the front end, the promotion and the distribution and where things are bought and sold, which is very much moving away from the idea that that retail is even a separate channel, and where things are being bought within the advert, effectively seeing what emerged in China with TikTok videos, where the buy within the video or the link in bio and Instagram created a new type of e-commerce that was massively compressed, and where the retail store in some sense had disappeared completely. So they're the kind of three areas. It fits into our overall thesis of distribution, orchestration, and infrastructure being the sort of three bits that most fintech and embedded finance applications fit into. So I was going to kick off with really why this space is hot and why we think there are opportunities there, given that in some sense e-commerce has plateaued for the last 2 years. The supply chains are in complete disarray yet again. And we're seeing that even the transacting payments, the public market stocks are off, but we are more excited than we possibly ever have been in a sector that most people are completely spooked by.
So I mean, the risk of being proverbial hammer that sees everything as a nail. I think what's exciting about this moment in time is that, I think a lot of listeners, if they're regular listeners, know that we do a lot of sort of first principles thinking and try to, take ourselves out of the reality and ask the question, like, what is the problem to be solved and how would you do it given, the set of tools or the environment that's available? And we're at a moment of time. And so that sounds really obvious, but what tends to happen is that mostly subconsciously, people, including ourselves, like anyone, unless they're super deliberate, and even then, is they take the existing paradigm, however the system, whatever system they're looking at, how it's working, and then they think sometimes very creatively and innovatively how you could improve that or maybe change it. And again, it might sound like semantics, but actually starting from zero and building it up from zero is, and you obviously don't want to do that every day. And it's actually not even germane to do it every day. But to your point about that whole world that you just described that we're going to talk about today, being in disarray for a variety of different related and unrelated geopolitical and economic and even climate, all sorts of different reasons. That moment of disarray actually is propitious for taking what is otherwise a really theoretical, almost intellectual masturbation type of concept, and actually being able on a 5, 10, 15-year horizon to start seeing that come into place. So that's one component. The other component is more classic. We've talked about a lot in terms of other parts or more traditional parts of finance, is the tool sets, the Lego blocks, or whatever metaphor you want to use, are all there, or maybe they're not all there, but there's a sufficient number of them, and they're sufficiently high resolution, and even the ones that aren't there, you have some visibility of when they might be there. And so you combine those two elements, it's like a crazy interesting time to rethink like if you really want to start first principles, everything you describe is, I think, and push back if you think I've missed something, but it's really about moving atoms through our economies and societies, and so it's real things. There might be some applications for services, but we're really talking about goods. So if you think about taking an atom of, I don't know, iron ore, and on the other end of that chain is a golf club in somebody's hand in, you know, the south of England. How would you do that today, trying to have a beginner's mind with the tools that both, and there's a lot of stuff has been built on the, what I'd say, the more the manufacturing and logistics side of it. But as you and I know, and I think increasingly the world knows, finance is actually way more intricately entwined in that. And you know, it's conceptually, if you're in a textbook, you want to separate that, but in reality, it's inseparable. Like one doesn't exist without the other along the chain. Financing, payments, insurance, essentially, from the atom of iron ore in Western Australia through I don't know how many transformations and wholesale, retail to the customer. And I think that's what's exciting. So that was super macro, so you can drill down now into like more practical examples of that. But I think that's the backdrop of why this time, that might be different, but like the world is poised to start seeing some real radical changes. And like the COVID, like, as I said, there's many reasons why all these things are in disarray, like the cards have been thrown up in the air. But one of the most important ones was the whole paradigm of the late 20th, early 21st century was about, you know, just in time, you know, global, super efficient supply chains, you know, in any sense of the world. And, you know, COVID made us realize, I don't think it was like nobody knew before, but it was sort of momentum and laziness made us realize how, you know, there's the optimization between efficiency and resiliency, you know, had gone too far. Yeah. And part of that is, you know, this is where talking about the intertwining of, we talked about this in a prior podcast, but the intertwining of finance and manufacturing, for instance, actually it's important to look at them holistically in the context of trying to solve that problem, because one of your, like in the context of insurance, something that you might do is actually build an additional factory, which is less efficient, but it insures against the risk of one factory going offline for whatever reason. And there could be a multitude of reasons. And, you know, right now that would be thought of as a manufacturing strategy, but it's actually a holistic, you know, you could, I think, reasonably say that's actually more of an insurance strategy, but it wouldn't be spoken of that. And I think going forward, it absolutely will. And people will be looking at, you know, the next 10 years about optimizing those trade-offs in a much more holistic way, which is super fascinating, I think.
Yeah, I mean, I think that's what we identified when COVID first hit. We saw this macro shift from efficiency to resilience. But we're also seeing now that there's a big difference between the type of inflation caused by investment in resilience and buffers and the potential catastrophic inflation you can have if you don't invest in it. So the only way to tackle inflation really that's caused at this level through all sorts of things, from the balkanization because of war and nationalism to the balkanization of supply chains caused by a pandemic, is to invest in this kind of resiliency. It's an investment. It's a way to keep inflation down. So I thought actually one of the things—
Absolutely, that's interesting. I never thought of this. I think you're spot on. That just made me think of something. Is, you know, and like the monetarists in our audience, I don't know if there are any, will like have heart attacks and unsubscribe. But you know, you could even conceive of central banks as part of their monetary policy, you know, financing, like instead of buying random bonds from like Apple or whatever, actually financing specific. Because right now, one of the things, just a slight diversion into the macro, is, you know, a lot of, as I think it's not a secret too. That's the frustrating thing. It's not like this is like some, you know, genius insight, but a lot of the inflation in the real economy and certainly exacerbated by monetary conditions, but it's not a monetary phenomena. If you can raise interest rates to 50%, that is not going to stop the war in the Ukraine, or it's not going to stop crops failing in India or what have you.
Yeah.
So yeah,
I think we're both aligned. We know that central banks are basically firing blanks at the moment, and that it's not going to. It'll make things worse rather than better.
Absolutely.
So I thought one of the things we could do then, because I think we've talked a lot about macro things, and in this one is to take a journey all the way through from mining some kind of raw material to selling a manufactured product, and sort of identify along that path where we think some of the opportunities are, because I think they're everywhere along that chain, both in terms of financial products and information products and physical products. So if I take the last example, one of the things that you sort of told me to look at a long time ago was space exploration. And I was like, you know what, I'm going to look at space and underwater exploration, and largely because of that sort of hackneyed adage that we know more about the solar system than we do about what's beneath the seas. But we are now mapping what's beneath the seas, and one of the sort of more interesting and more controversial things is that we know that the types of raw materials that we need for making the new types of things we need to make, like electric cars and massive amounts of batteries, they're coming from places that are being disrupted for the reasons we talked about. They're coming from places that are geopolitically unstable and have resulted in, let's say, class action lawsuit against Apple for using cobalt mined in the DRC through child labor, right? Real stuff, really important stuff that percolates all the way up into tech stocks and where we play. But we know that now by mapping the seafloor that we're finding these minerals underwater, specifically near geothermal vents, where there are large deposits of these things. And these are in international waters away from geopolitical risk, but obviously there is potentially huge environmental concerns if we go after these things. There are also, there have been contracts awarded to about 8 or 9 countries to look at mining these resources now. So it's going to happen in the same way that, frankly, North Sea oil rigs still look a little bit like science fiction. Taking raw materials from under the sea is not a new thing, and it's going to happen. This is from deep sea. It's very different from a relatively shallow.
Then absolutely,
But it's possible now, and we can see that if we look at the technology involved in things like mining, from self-driving vehicles in quarries to underwater drones, it's real. There is real progress that is actually more exciting than, let's say, SpaceX in some ways. It's where actual engineering hardware has specific business applications that then open up into a world where we know also that there are massive pricing issues and opportunity there in terms of raw materials and commodities. So I'm super excited about mining as an area that traditionally is the antithesis of fintech or tech in general, but now is sort of front and center of it, I think.
But all those things will need to be financed and insured. And I think actually, when you talk about that whole chain, I feel like this is a provisional hypothesis that front end of the chain at the commodities end of the spectrum is probably already better served. And where the relative advantages, not that there aren't any, and I think they're manifest, but the relative advantages of the new sort of financial technological paradigm are relatively less valuable than on the other end of that value chain. And I know you've talked a lot about, the sort of blending of, or the potential for future, the sort of clear emerging trend of the blurring of lines, but from the factory floor to the consumer's closet, in terms of wholesale, retail, payments, financing, insurance, and the very simplistic version of that is direct from factory to the consumer. I think that does exist already today in some instances, and I'm sure it will exist in the future in some instances. But I think that narrative, which I've heard quite a bit about, is which is the classic get rid of the middlemen. As you know, that's been like a bee in my butter for 20 years, is that middlemen, some of them you absolutely want to annihilate, but like middlemen it's like everything. It's like, it's complicated. There are I use middlemen as like intermediaries that are just a tax, or historically served a purpose, usually informational, and that was a tax, but it was a tax worth paying. That is no longer the case. So just blindly getting rid of middlemen seems, but there's also oftentimes, and more, whether this is in real estate or in consumer retail or business to business, where there's an element of curation and coordination and orchestration. The orchestration layer, I don't think goes away. I think it's radically different in how it will manifest itself and the winners and losers. But to say that just magically you can wave a wand and everything that is ever demanded will be built in real time or ish and exchanged is sort of this like fantasy narrative, I think.
So I think you're right, that orchestration layer changes a lot. But before we go into the orchestration bit, if we take that second step in the journey from mining raw materials to the assembly of these raw materials into products in supply chains, and then the shipping of these things, there are specific opportunities there that are massive as well. I mean, we've seen the elephant from there.
Absolutely.
Yeah. Flexport was the elephant in the room, in the sense that they realized that, we know at any one period in time what's on every single aircraft in the world, because the regulatory environment aircraft move in was a 20th century thing, whereas the regulatory environment that ships move in is like a 16th century thing. And so they, nobody knows what's in the.
Were there fax machines in the 16th century? I wasn't aware of that.
That's what's fascinating, is exactly somehow this, but there is a connection there. I think that this extremely old-fashioned world is like content with the fax machine. Okay, that's good enough.
It's actually
technology needs to be.
It's actually worse than that. I'm going to be careful because this is really anecdotal and I don't really know what I'm talking about. But I have a number of friends, or Geneva, as you know, is one of the biggest, if not the biggest, physical commodities trading hub in the world. So I know a number of people work. And the prevalence of faxes in those shipping, like for crude oil, let's say, or bulk metals or what have you. Apparently, and this is maybe 2 or 3 years old, but I really don't think it's changed. Is shocking. And the question I asked actually is like, okay, but like, do people even still have I had one friend who said, actually, no, it's funny you should say it. It reminded me of the old, well, not the oldest, I think it still exists, the problem of finding COBOL programmers to like maintain mainframes in banks. He said, yeah, like it's a real issue. Like, how do we maintain our fax machines? Because nobody sells them anymore. Nobody maintains them. And there's an element of inertia, clearly, but there's also an element of really, if you're really cynical about it, it creates a lot of friction and opaqueness. And for the people that are running that system, that have sort of masters of the universe, mastered the intricacies, and it's enormously complex and intricate, that's an advantage. Until it isn't.
We saw it in real estate as well, where real estate transactions are of such high value that efficiency is not an issue, because they're so high value that why would you make it? It's worth putting a human being in there.
Yeah.
And secondly, once there is a human being in there and there's a broker on both sides, they're not incentivized to look for either resiliency or efficiency. They just want to make, they want to be asymmetric flows of information. And the same is happening with some of the world's supply chains. So but I think that's what's been so important about COVID, is there's a point where it just breaks, and therefore suddenly in that vacuum, there is the sudden need for all sorts of automation and to create that resilience or whatever.
The metaphor I often use, it's not perfect, but it's like a seawall that gets breached, right? It's like impenetrable, until it's not, and then when it's not, it like catastrophically like. And I think we're at a moment in time, coming back to like our big introduction, where it's being breached, and so that's a bad metaphor because that's like something happens at a moment and it's sort of instantaneous. But I think in our context, translating metaphors over the next 5 to 10 years, those kind of barriers are going to be breached, and it's going to be inevitable, irrespective of how much resistance or inertia there is.
Yeah.
Yeah.
And so there's specific opportunities in this, like you say, this breach. I used the metaphor vacuum. I think the breach is probably a better one, like you say, is that suddenly there is a need for something very different. And I think beyond the opportunities like Flexport, there are two. One that plays, and they're linked and plays exactly into our space, is that supply chain financing became very unfashionable because of some, notable failures in that space. But it's a brilliant idea because it aligns incentives to pass risk from a lower risk place to a higher risk place. And so it's a very nice thing in the context of integrated supply chains. And then beyond that, and obviously is a...
Well, the other thing is historically, and the providers of it will, if any of them are listening, will probably vehemently contradict this, but historically, supply chain finance works if you have all the data. It's sort of like, and it's not like some of the data, it's like all the data. And then it becomes, it's like intertwined. Finance is information, like one of our past, and the way that it was underwritten historically was, it would be dishonest to say there wasn't any data involved, but it wasn't granular. It wasn't real time. It wasn't high. It was macro data, right? And that works until it doesn't. And you tend to have in any market, not supply chains or bond markets or what have you. And then you have like a catastrophic event, and as you say, then it goes out of fashion and prices go up to pay for the world that we're going into. Is to your point, like from the mining to the assembly to there's going to be, if there isn't already, there probably is already, it's just not very well orchestrated, data along the whole route.
Absolutely.
That will facilitate real time, what I call micro underwriting. So instead of underwriting the supplier, you might underwrite that golf club.
Yeah. So the thing, I don't know if you've seen that I got most interested in this week was a group managed to map the supply chains of an entire country. They mapped Hungary, and the way they did it, they looked at VAT records, because of course VAT records are involved in every single transaction. So they're able to map an entire country's transactions. And from that, they found that of the, let's say, I think there were, let's say 300,000 companies in Hungary. It was hundreds of thousands.
Yeah.
But 100 companies were responsible for 75% of the systemic risk in supply chains in Hungary. So concrete data about this should be done by governments in every single country. It's a very, it's a perfect example of what's the data set you need, and the data set you need is sales taxes. And so and so I found that fascinating. But beyond this sort of systemic risk, the product that I think exists to couple with supply chain financing is the next generation ERP system, because and it's a shared ledger system, but nothing to do with blockchain, because you don't need the security of a blockchain environment where there are hundreds of people cementing a transaction. You only need, say, like a dozen or something like that. And with a dozen, you have shared permissions on a database. You don't need anything blockchain-like, it'd be overkill. But you would genuinely have the incentive for a shared ledger within a supply chain, where the current modality, if you like, is someone has SAP and and all the little guys have to basically match what the big guy has.
Yeah.
We know historically that hugely enterprise model eventually is challenged bottom up from a smaller one. So in the same way that Siebel was replaced by Salesforce, I think there is a Salesforce of ERP, and it's not NetSuite. But this could be a massive opportunity for a new ERP system that genuinely works for the smaller suppliers.
So what's because there was a whole like I like that metaphor CRM because in the sense that there was a whole cohort probably about 10 years ago, maybe 7 to 10 years ago, there was a sort of a little mini Cambrian explosion of a small business ERP platforms. I can think of like 5 or 6 off the top of my head. I'm sure there's like 40 or 50 in a period, like interesting for startups, so they cluster like that. And I don't think, I don't want to be canonical about this, but I don't think, certainly none of them has become a Salesforce type metaphorically. And there might be 1 or 2 that have been reasonably successful, but what's different now? Like, because I like that idea. I think you're right, but help me understand what's different today. Like it feels a little bit like the people that were doing those ERP programs were, it's sort of like the internet, consumer internet in 99, 2000. Their vision was robust and directionally correct, but it was too early for a number of reasons, maybe. And now it's not too early anymore.
So this, you caught me out in the sense that I don't know what the product looks like. All I know is it's not blockchain. That's a blind alley. But I do think the disruption in the environment has happened to create that there's an ecological niche now to be filled, whereas there wasn't before. So people were trying to build something that wasn't really needed. Now it
was a nice to have, not a must have, and
So it's possible that it'd be a great piece of analysis actually is to look at these companies, because it's possible that the same product done now from scratch would work. And that,
so one of the things, one of my instincts, and this is like this is really I'm over my skis. I don't know enough about it. Is that even the way that you build product, like codes, is. I remember one of the problems of those early day products where they worked, but they were not flexible or enough or customizable enough, and that was a fundamental. It wasn't like a product problem. It was my understanding, anyways. That was a fundamental way of how you had to build them. Whereas today, with different sort of, the whole SDK API world and different sort of programming frameworks and the way of approaching that software, it seems more plausible that you could build like a sort of an infinitely customizable ERP, which is actually what you need if you're going to address the SME market, because the customizations are radically different, but every small business is slightly different and on their own. Every big business is like that too, but if you're a big enough business, then you hire a systems integrator and like there's enough money to go around to like, customize it for you.
I never thought of that, and that would be hugely contrarian way of building SME software, which normally tends to be simpler. So it could be that is exactly it, that ironically, for the first time ever, you need to provide an SME response that is more enterprise-like than the enterprise people, but it can be configured much more cheaply. I think. That's super interesting. So if we move,
and then if you have that ERP, you say, okay, that's like this is something I thought that you've been working on. It's really interesting. What is it? Why is that important? Other than it's like potentially a really big market and interesting, but for the bigger conversation, having, let's say that exists, or a whole ecosystem of that exists, and you have a new paradigm in ERP for all businesses, not just giant businesses. What does that do to supply chains and the bigger question we started with?
Paradoxically, it makes them more efficient. In a model where we say that what's needed is resiliency, but I'm hoping that, as we said to start with, resiliency is going to come at a cost, so we need to find some efficiency elsewhere. And so the resiliency that we will build in will be deliberate, in the same way that Zara will produce the same goods offshore, nearshore, or onshore. They'll replicate the factory process because they know that they need that resilience for the speed efficiency in their chain. So it's like we always say, it's complicated. It's not a straightforward thing, and we will always need more efficiencies in some places, and particularly I think as we invest in redundancy or buffers or resilience. So it might be that these ERP systems are able to, let's say, schedule automatically as things change the rerouting of supply from one place to another, to say,
Yeah.
actually, this week, we know that there's a bottleneck elsewhere. So we're going to move the manufacturer from here to here.
And then it's super important to have this integrated, embedded, contextualized, whatever jargon you want to use, finance, because you have to shift your financing flows, and that is in today's world, that would be non-trivial. Let's say if those two different factories are in different countries, they might have different banks, they might have different regulations, they might have different credit agreements, they might have different insurance contexts like that. It's non-trivial to say from a manufacturing point of view already it is, but let's say you had all that solved and you had your ERP that could but then you've got the finance has to follow that. And again, if you're a big enough company, if you're, I don't know, Apple or whatever, you can, today that's doable. You can build that, but it's super expensive and super heavy, and there's giant economies of scale that are needed. So what you need is that embedded finance to say, okay, I'm going to automatically switch my manufacturer of this golf club from this factory to that factory, and everything follows: payments, financing, insurance.
Exactly. And we know that all these things which have payment terms which are very long, there's a reason why it's 30 days in the sort of the business setting, and whereas it's instant in the consumer setting, is because there's all this uncertainty and buffer and things like that. So as soon as you can, we know that the future of everything is some kind of real-time model. These buffers, that's the resiliency. The resiliency that's in supply chains at the moment hurts the small suppliers because the resiliency is in the
it crushes them. That's super important. There must be research on this. I'm sure somebody like, I don't know, World Economic Forum or Central Basel or somebody has done, if you could reduce average payment terms from 47 days or whatever they are, even forget about the whole world, just pick, I don't know, Western Europe or to 3 days, that's got to be worth trillions of dollars.
Yeah, exactly. And I think if we then use that, we know that that's an efficiency gain. We know that that has to be bought with a resilience elsewhere, because the reason those buffers are in place, but they're hugely unequal. They favor the big.
Oh, absolutely.
And so they create, and particularly if we map some of these systemic problems, because not all of the supply chain people that are systemic are the big guys. And look, the mother of all supply chain problems that we have at the moment is the types of chips that are needed for smartphones or things that require very small etching.
Automobiles or...
Most of it's in Taiwan. And one company, TSMC, is basically the bottleneck for all. So you've got cars sitting in a parking lot in Germany because there's one chip missing because there's a bottleneck in a supply chain from Taiwan in a place that's now geopolitically unstable.
Fragile.
Unstable is the wrong word. Fragile.
Fragile.
So we know, and actually something that,
and
again,
building a chip foundry or supply chain is non-trivial. No matter how much money you have, it's not something you can do like that.
So they figure it's going to take 5 to 7 years for the people who are already building them, which are US, India, and China, to build them. Europe, as usual, has been late. But ironically, Europe's in a slight position of power because some of the technology, effectively the machine tools for chips come from Europe, and therefore Europe has a position of leverage there. So hugely interesting. So anyway, so we've done sort of mining, and then the sort of assembly structure. The next bit is swimming upstream, is the orchestration layer, which in a weird way in retail is less interest, although it's been the focus of most of fintech, and hasn't been a place where we focus because it's been compressed, if you like, by more of retail shifting towards the marketing end, which we'll talk about, and more of the supply chain stuff and the logistics stuff moving out of retail to a different market. So what's left in that orchestration layer?
Retail just becomes, to use old terms, it's almost only it's only merchandising now.
The fact that we store a store when it doesn't need to store things is a legacy problem. But in terms of the transact, I mean, one of the things that is quite interesting in the sense that if we talk about Bmpl, which is sort of elephant in the room there, that the reason that Bmpl was considered to be strategic and not just a way to offer people high purchase loans or layaway loans and everything, is, and I think some of the complaints about it are overblown in the sense that people are claiming that it's insane that people are buying pizza with BNPL. It is insane, but are you telling me that nobody is buying pizza with a credit card? They are. And so.
No, but a credit card is a much friendlier consumer product in that context. So if I buy 10 pizzas in a month on a credit card, I have one bill, I have to pay it or I don't pay it. There's a whole, so the whole credit aspect. If I have 10 BMPL like installment payments on a different day of the month, every, like that's anyhow.
So I think that's a temporary problem. That UX problem goes away.
Yeah, that's a UX. It's a UX
it's
problem.
Consolidated.
Absolutely.
But the bigger problem is the ethical one of, are people getting into debt unnecessarily?
Yes.
And I would say that.
And as a frog boiling in a pot, not only unnecessarily, but is the product fundamentally compared to a credit card? You can kill yourself with both, but is it fundamentally easier to, like a frog boiling in a pot, to get yourself into trouble with BNPL than it is with a credit card? I don't know the answer to that.
So I think you might have a
plausible.
In the complexity might hide some of the issues there.
Yeah.
So that's actually, I hadn't thought about that. That's the most valid point against BNPL, is that increased UX complexity means that there's an opacity towards being in trouble. And so, because I always thought it was a more ethical product because you were able to offer a rate specific to what you were buying, as opposed to paying an egregious rate because you didn't know what people were buying.
Yeah. So I don't know. I always been a bit of a finance nerd since I was a kid, and like have used Quicken or what, I always, but I observe like my children and most people, like this is super anecdotal, but like I think it's robust. They pay for things and then they look at their bank balance or their credit card balance or their whatever at the end of the month, and that's it, right? And they don't pay attention to stuff. So the UX of a credit card, at least there's a point in time once a month where it's like, holy crap. Whereas with BNPL, like I think the risk is that it's like, this is not good, but I can't see the forest for the trees. Now you absolutely, if you're on top of it and like the 10% of the population that are sort of budgeting finance geeks or whatever, there's no difference between those products. They can manage that. It's like, I don't want to say it's like rocket science, but for most people that don't really pay attention to their finances and don't want to, and I that's not patronizing, like that's how we should probably mostly live our lives, then it's potentially dangerous. But anyhow, that's a bit of a red herring for this.
So there's another bit, and I think it's why BNPL was seen, certainly by some investors, as being hugely, potentially the first market-driven disruption of the card companies, where the card companies are the most difficult people to disrupt in the universe because incentives are aligned amongst so many actors.
And they work, and it's pretty efficient, like it's people like to complain. It's a pretty good service, right? At a pretty good price.
It's expensive debt, and it became, and it wasn't intended to be debt to start with, as we say, that somebody had to write the transaction before things were electronic. And so, but for whatever reason that has happened. But the thing that excites me most about it is, when I started, the thing that I always wanted to build was, I wanted an interface that was the thing that automatically bought or scheduled everything that was a recurring payment that was boring, from toilet paper to my dentist appointment.
Yeah, well, that was sort of what Amazon buttons were trying to go for.
Exactly, and Amazon have a lock, but Amazon haven't built this thing, and so for whatever reason they tried with dash buttons. They're distracted. They're a huge company.
Yeah.
But for me, the single application I want is something that looks like a calendar that basically I hit pause if I have too much toilet paper, and I hit pause if I don't want to go to the dentist, and it learns. And over time, that single one button schedules and manages the payment of everything. But I can't do that because when I go to the supermarket, I get one receipt itemized, but that doesn't appear in my bank statement. It appears as a single item. So what BNPL does, by suddenly
it gives that data all the way back on an itemized basis.
So I think that's the biggest disruption of BNPL, is that it's by looking at
absolutely, but that's where the risk is, that it actually solves a very real problem and adds real value, but on the back end, while potentially creating and so I'm sure this will be figured out. This is not that hard. It's not trivial, but where you get either the credit card paradigm or the Bmpl will figure out how to like make that UX on the front end or on the back end, in the case of credit cards, work across the whole value chain. And I think it's a race to like, I think that's where the world's going. Because as you pointed out, it's just like,
think the credit cards will have the SKU level data? Because that's the point where
well, they will have to at
Yeah.
some point, right? I don't know.
But are the merchants
Yeah.
incentivized? You see, the merchants are incentivized to give the BNPL players that data because the merchants are actually using it as a customer acquisition cost. They're underwriting the loan. Whereas in the credit card model, they're not incentivized.
No, not now. And so this is why it's important. Like when I say I don't have this all figured out for sure, otherwise I wouldn't probably be even talking about it. We'd be investing and building. But this is worth thinking about. So this comes back to my point. You have to pull yourself out of the paradigm. Okay, starting from zero with the credit card, with the rails, which are actually not credit card rails. It's like a combination of payment rails and the banks and whatever. You have to reinvent that. And part of that, I would imagine, I don't know this for certainty, but I imagine part of it was, okay, how do we incentivize merchants in this paradigm to share that data? I don't know the answer to that, but it seems inevitable that there's going to be some sort of convergence. You know, I don't know.
I think that's the biggest thing, but I definitely think that that's what a firm we're going after. And that's why I think these things are more interesting than they first appear. They are, if in this race to getting the metadata at the transaction level, at the SKU level, if the BNPL players win that, they become the new payment rails. They're the first challenge to the that we've seen.
And so if I was running a firm or any of these other, I'd be worried a lot about this UX thing. And I think that's eminently solvable, right? Like I don't think it's like anything. It's like conceptually, it's quite easily solvable. The devil's going to be in the details and stuff, but like it's not an intractable problem. And I think if they sort of sit there and don't address it, a combination of, well, I think it'd be a combination of consumers blowing themselves up and regulators like shitting all over them, and those things are obviously highly correlated. You know, could snatch defeat from the jaws of victory. So one to watch for sure.
Before we move on to the sort of the front end, the marketing and the purchasing,
I'm just conscious of time, David. We might need to do a part 2 on this one.
Or we continue. Do you want to continue, or we do part 2?
Well, I've got a hard stop at the top of the hour, which is only in a couple of minutes. So
maybe we'll do a part 2 before we do part 2, which will be on the front end. All of that transaction.
We could actually, this could be like a 10-part series.
That's why I find it as an interesting narrative.
Yeah, absolutely.
Like from the source of the Amazon all the way through to the sea, there is opportunity. And so but before we start, just to wrap up on that, why is it that Bmpl is the other thing we talked about that? Like what are the other things in that orchestration layer that you see that are interesting in terms of disruption? Because I end up constantly going back.
Well, actually, I think, and this is like, as you know, I think, we have one company in our portfolio is doing this. So it's a little bit, disclaimer, disclosing a bias, but it's like Bmpl as a sort of a hackneyed, like shorthand for in the business supply chain. And in that context, it's intricately linked with financing, insurance, that's probably the place in the financial firmament where they're the closest, right? Where one doesn't exist, it's trade credit essentially, or credit insurance. And there's a whole bunch of structural and regulatory and usage reasons for that, but it comes down to, like you were saying earlier, that's the thing in this conversation that got me the most excited. If you can take 30-day, or I think the average is actually longer than that, but 45-day payment, median or mean payment terms, and build infrastructure that structurally reduces that to, as much as possible. Ultimately, asymptotically, that should go like consumer finance to like sort of zero, or real time, or maybe not in all instances, but I think that's where and everything we were talking about in terms of Bmpl is equally germane down that value chain. We just don't I think we talk about consumers because that's happening, and there's some very big companies and they've been very successful, and there's a lot of real world examples. Down further in the chain, a small business buying from their supplier, or a big business for that matter, but a business buying from another business, the paradigm is very similar. And the way that was done historically, maybe there was a bit more granularity. It wasn't done with credit cards, although, but it was done coarsely. So, actually the way I look at credit cards and BPL is they're almost like a good company and a good individual should use both. It's different parts of your balance sheet. So if you're a company, if you're a corporate treasurer, you have a revolver with your bank, and that covers like day-to-day stuff, and like you don't have to worry. It's like it's basically cash flow smoothing. And then if you have a fundamental structurally, like it's a one-off or you're structurally indefinite, then you refinance part of that revolver. You don't use that revolver infinitely to finance things that need to be permanently financed.
Yeah.
You take out a loan, whether that's for 2 weeks or a month or what have you. Bmpl, I think, is in that. So right now in supply chain finance, in the B2B part of it, you have, some small businesses don't have revolvers. That's a problem. But like if you have a revolver, and then you have, if it's a big enough item or long enough time, you specifically finance that item or that shipment or that container or what have you. I think BNPL for SME or BNPL, forget SMB, BNPL for business can actually combine those two because the revolver was a response to the cost and the friction of running like multiple tiny transactions. And that's no longer an issue if you've got the right ERP reporting technological platform.
I think that's a super interesting observation that throughout all these things, and the fact that we've talked about loans throughout all of this, is that the nature of transaction in businesses is this spread, if you like, between cash versus accrual accounting is something that can be narrowed by these things, where you can have the real-time view, and then once you have the real-time view, then cash and accrual-based accounting, just the accrual has a discount, and so but you can have a snapshot. So you can smooth the cash flows potentially on absolutely anything, and that's why there is this interplay. In order for this new world to happen, where all cash flows are smoothed, all supplies are integrated, and there is visibility, that in that environment you need to have the metadata, if you like, of exactly what is being underwritten at any one point in the cash flow smoothing. So instead of you underwriting a single invoice, it becomes super granular. You underwrite the portion of the invoice that has been fulfilled, or
or even again, thinking outside the box, the way that people invoice. One of the reasons because it was there was a cost, and like you might, a world with a ubiquitous, really robust ERP accounting might invoice every single thing, right? And in today's world, with the systems that we have and the way that they operate, that would be overwhelming, and the cost of managing those, taking what is now combined into one transaction or one invoice and making that 200 today would be insane, because the frictional cost of doing that would be too high. But in a today, a theoretical today, or certainly a very near future from a tech, if you can get rid of that transactional or operational friction, which I think we can today, or have visibility on doing, then you could turn one invoice into 200, and and everything be super granular, and manage then on a holistic basis in the system. And then you could slice and dice risks. This is the whole principle of securitization. A future world of securitization where it's then you can get super granular about, I only want this risk. I only want risk from, we're going to make something crazy up, but I think that's even plot. I only want risk from, noon to 7 p.m. because I only want transatlantic HRSAT risk or whatever. And I'll insure that, for a small price, but, I'll take that off the table.
So I think, to conclude, and then we can do part two, I think we got to quite a profound endpoint, which is, and it plays out across everything we invest in, whether it's insurance, whether it's payments, whatever, is that in order that the general trend of a networked economy is for everything to become real time, and in order for that to happen, it has to become granular. And that this combination of real time and granularity, it's ubiquitous. It's everywhere, from securitization to payment, whatever, to metadata about transactions. And in this macro shift where we need to build in resilience as well as efficiency, we know that this trend is not going to stop, this trend to real time and granular, and therefore
no, it's and we have examples of
resilience automatically.
Yeah, that's the direction of time. It's time zero.
Exactly.
And like we have like one example I was just thinking of is like music. It used to be bundled, then it was single songs, and now it's streaming. You know, like there's all sorts of examples. Everything is moving in that direction. The bundling in the past wasn't because our ancestors were stupid or too thick or whatever. It's because that was a very rational response to the cost. It's like Coase's theorem, the costs of the informational and transactional costs of being granular, right? And it was like a local optimum of how much do you bundle to to mitigate those costs.
The first ever internet company was called Real Time Anywhere, and everyone thought it was too much of a mouthful. And I was like, no, that's what I want to call it. But it's interesting seeing these things now. Sort of, that's the lens I'm looking at through the finances. That seems to be what's happening. It's real time anywhere, but with this granularity component added, which is super important. Super.
Perfect. So
I think we got there. Next time we'll talk about.
Thanks, David. Thanks everyone for listening, and listen to this one first. If you're listening in a bunch, we'll do part 2 soon. But you have to listen in order, because otherwise we'll be incoherent, I think.
Super. Thanks very much.
All right. Bye.